How are you balancing these day-to-day reversals in at least trade news?
Well, I mean, it's no surprise that you'll get volatility around uncertainty with policy. I think for investors, you really need to answer the bigger questions. Are we still in a secular bull market? I believe we are. I believe secular bull markets are going to end with great euphoria and significant policy tightening. So we're not there on either front. The question for investors now is, do we get a better policy that leads to improvements in economic activity, steepens the yield curve a bit, or are we just going to kind of be in this slog? Because that'll have real implications for your portfolio. I suspect we'll get incremental improvements. Rates will go up a bit. The yield curve will steepen a bit. You'll get a little bit of a cyclical rally in here. Ultimately, we'll go back to where we've been, a 2% growth economy with policy not doing much of anything.
Same thesis from you?
I think ultimately we could get back to around 2% trend growth by the end of next year, but I think we could have some turbulence before we get there. I mean, we saw the data this morning, service side of the economy starting to slow a little bit. Manufacturing ISM on Monday was a bit disappointing as well. So we see scope for the malaise that we've seen in the manufacturing side of the economy to broaden out slightly as we hit the first quarter of next year. So I think we could have a turbulent start to the year before we approach trend growth towards the back end.
Are you spooked by ADP this morning?
A little bit. I think that the data generally this week has been a little bit softer, and I think obviously we have a lot of trade-related volatility in the background, which is ultimately, I think, going to set the tone directionally into the back end of the year. But I think the data is turning into more of a headwind than a tailwind at the moment.
Yeah, I mean, goods producing did not show up in ADP, although some are trying to decide whether or not this is one of those weird outlier months that they sometimes give us.
Well, look, I mean, we've been dealing for a while now with policy uncertainty that has been disruptive for business investment, and at some point that starts to feed into the job market. But in my opinion, that's been the story of 2019. Got the Fed to start ease policy. The story of 2020, I suspect, will be incremental progress on trade. I don't think we're going to get a fully baked trade deal, but incremental progress, a better tone, and that should lead to some improvements in sentiment, should help to stabilize the business investment and the jobs market.
We've seen markets rise and fall on what President Trump has to say about trade, and it is widely contradictory from day to day. When you look at the momentum heading into the political elections next year, do you anticipate the markets responding in a similar fashion to what happens on Capitol Hill and what happens in the campaigns?
Yeah, I absolutely think we'll get election-induced volatility. I think as we move into Q1, the Democratic primaries are going to be a source of volatility, and at the back end of the year, around November, the election itself will be. When we've looked at previous election cycles, what we've seen is in aggregate, election years are not more volatile, but you do get these pockets of volatility around the primaries and around the actual election dates.
But let's be clear. I mean, we've seen markets rise meaningfully this year in a year where investors were very concerned about the policy direction. And so in essence, what has happened is we've seen a better tone. Fed easing, administration backing off a little bit. The last few days have created some uncertainty, flattened the yield curve a bit, led to volatility. We can expect that in the coming year. But again, remember, this has been a very good year for markets.
Is there a reason for the markets to have risen that high, though? I mean, I had a guest on Monday who argues that this policy of easy and free money means that companies have gone in, they've offered up bonds, and they're using that money to buy back stocks, which is boosting the equities. I mean, is there a good, solid reason why we're seeing the rally that we've seen this year?
Yeah, sure. I mean, look, if you look on a price-earnings basis, stocks are a little bit expensive, but not excessive. So earnings have done well in this environment. And, you know, in a world where growth is going to be modest, inflation is generally non-existent, and central banks can't really raise rates, in fact, most central banks around the world are easing, that should favor risk assets. I was particularly worried in 2016 and 2018 when the Fed was raising rates, strengthening the dollar, flattening the yield curve. That's when investors need to be more cautious. But no, I mean, the fundamentals look reasonably sound for businesses. We're not overly excessive on valuations, and stocks are still generally cheap to bonds globally.
Some desks are arguing that U.S. will lag in 2020. Are you a fan of other parts of the world, ex-U.S.?
I think our view on equities generally is that we expect low single-digit returns next year, and we do think that the U.S. could underperform in that context. We've seen a little bit of a resynchronization of growth globally with the U.S. slowing, so I think that does set the scene for EM or Europe to potentially outperform on a relative basis to the U.S.
Would you take a flyer on Europe?
Yeah, I would take a flyer on Europe. I mean, the thing that investors need to think about is how is policy going to affect capital flows? So the big struggle over the last number of years for international investing has been the strength of the dollar. And so in an environment where the Fed is on hold or easing and you get progress on trade, that should take some pressure off of the dollar and capital to start be attracted to overseas. So emerging markets and Europe. But you need a good policy mix for us to get there. I suspect that's where we're heading, but that's what it's going to require.
We certainly know that's on the president's mind. Guys, thanks. Good to see you both.
Thanks a lot.